Jyotivardhan Jaipuria joins us now for a quick take on the markets. And Jyoti, uh, irrespective of what the economic numbers are, how rich the valuations are, markets are going from strength to strength.
Yeah, to be fair, what we've seen in the last 3 months is a bit of consolidation where markets are like, we are probably seeing a bit of time correction. We've not seen really a price correction coming through, which a lot of us were expecting. But a time correction is there. You can see that the market is now consolidating, not really, going up the way it did in the first part of the year.
Having said that, Jyoti, we've been, talking at length about the recovery in the earnings cycle. That seems to be eluding us. Do you think we can be lucky this year? Because thus far, what the GDP numbers have been indicating and how Q1 earnings have panned out, it seems like we're going to be seeing more of the same from what we have witnessed in the last few years.
Yeah, see, like I guess a lot of us were expecting Q1 and Q2 to be weak anyway because of the impact of the GST. Once we get into the second half of this fiscal year, what you have is like a base which is reasonably weak because of the demon of last year. So from the second half of this fiscal year, you have 4 quarters where the base is weak because of demon, because of GST. So you'll probably see earnings look optically better than what we've seen in the last few years. But that is to my mind not the real recovery. It's whether we can build on those gains and we see even the subsequent quarters do well, that you can say that the earnings recoveries come. But like if you just look at it from a market point of view, you're probably going to get 4 quarters after the September quarter which are going to be reasonably strong on a year-on-year basis.
Jyoti, it's interesting to see that we've had a volatile last month for the markets. You've had the Q1 GDP number, which has come in at a 3-year low. But irrespective of that, the underlying strength and consumption demand continues to ride high. And we can see that with the monthly auto sales data, which has come in. It's been just so strong across categories, from both Maruti to a Royal Enfield on the other end. And we were just chatting with 2 of the CV players, and they were also saying that the commercial vehicle demand, the OEM demand, it's all looking extremely strong. Tell us, how is it that you're positioning yourself within the auto pack right now?
Yeah, so our theme has been rural India over urban India, so that's what we are really focused on within the auto pack. Also, we like tractors, two-wheelers, so we like more the rural theme because that is something which is a little more certain. You have a good monsoon, you have rural India which will do well, and I just like that theme over the next 2-3 years. So that's where our big focus has been in the auto pack. And just a quick word on these numbers. What's happened is because of all these distortions of GST, we first had destocking in the month of June, and then slowly we are starting to see restocking. So even in the auto space, that's what we are seeing, where the retail demand is not as strong as what the wholesale demand is, because we're seeing a lot of restocking happening ahead of the festival season this time.
Okay, so how do you balance out the chance of an opportunity in the market? Because you have frenzy, which is driving a lot of the interest in financials, in consumer stocks, staples and discretionary. And on the other hand, you have these potential turnaround stories where it's, high risk for high reward. But there's a lot of risk that you need to take. And, one doesn't really know that in an otherwise certain market where there are certain opportunities of growth, one should venture into the uncertain zone.
Yeah, what we tend to do is, look at stocks where we think that there is a high potential of growth, but the downside to that growth is going to be minimal. So the way we tend to model is, okay, what is the base for this company over the next 2-3 years, and what is like the upside potential in earnings possible if, things start to improve, and can we justify current valuations at base. So quite often you reach a scenario where you think, okay, in the worst case, I don't make money in this stock for 3 years. In the best case, I could, more than double my money. And those are the stocks we tend to buy. We generally tend to stay a bit away from really expensive stocks, because our theory is that we can buy stocks which are cheaply valued, where things will improve, and you may not perform for the next 3 months in it, but this is something which will give you a much bigger return, and at least on the downside also you're protected. So it is a bit of balancing act. You may take some hit on the short term, but you'll probably make money in the longer term there.
Okay, Jyoti, have you started buying into pharma and IT?
IT, the answer is no, because like I've said it for the last 2 years, I don't think it's a sector which is, I think it's a sector which structurally the growth has slowed down. So to that extent, it's not a sector which we are very excited about. We may nibble at IT a bit more just as tactical plays that, in a down market, it probably will tend to outperform the market, but it's not something which we want to buy like for 3 years. Pharma, yes, we bought a couple of stocks. It's not the big cap stocks, it's the smaller cap stocks. These are more focused on things like CRAMS.
Jyoti, of late we've seen a lot of momentum which is back in real estate, JP Associates, HFCL, Bombay Dyeing. What explains so much of underlying momentum? Because at a time when FIs are selling, DIs are on and off, who's buying some of these momentum stocks?
Yeah, so it's very typical of any market, right? As the market keeps rising, people look for more and more laggards, and the risk appetite of the market keeps going up. So, stocks which are not done well, people tend to, keep looking at, okay, this is not done well, and in XYZ scenario, the stock can do well. So you see some more and more of those laggards starting to perform, and they do really perform very strongly because nobody really owns these stocks. So when they start performing and a couple of people start buying, you can see sharp spikes in those stocks. And maybe there are business cases in some of these to really do well, whereas in some of the others there's a lot of hope which may or may not materialize. So it's a very typical thing which we see in most of the bull markets over the last 20 years. So there's nothing very different about this time.
So tell us what else is looking interesting right now, Jyoti, because the market clearly seems to be drying up of fresher ideas, which is why perhaps you're seeing all these untouched companies coming back into the fore. What is it that you're keeping on your radar in terms of something that you would like to buy perhaps?
Yeah, so the rural is something which we have been buying, but in some sense it's well flagged, and so everybody knows about it. I think there are some interesting ideas in the capital goods infrastructure space which are not as high debt and as risky as some of the names Nikunj mentioned, which probably will do well. There's not much interest in them. Again, they are totally under-owned, and these are things which will start to do well because demand is starting to pick up. The second thing is we've seen government really is focused on this Make on India, and in a lot of sectors we are seeing Chinese goods being a threat or Chinese goods being like a big market share, and we've seen anti-dumping imposed over there. We see other measures to control the Chinese so that the Indians start doing well, and that's one theme which we are seeing in even the infrastructure sector, capital goods sector, maybe the chemical sector, where Chinese was like, let's say 25% of the total market share in India. You've now got some anti-dumping measures, you've got some other measures coming in against the Chinese goods. So the domestic players will keep taking a bigger share of that market away from the Chinese. So that I think will be a big theme which we'll see over the next 2-3 years. There are lots of opportunities there where things are relatively much cheaper.
Right. Jyoti, we leave it at that. Thanks very much for taking out the time to speak with us today. Really appreciate your views and your insights. For helping our viewers navigate through the market better.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.